Hi everyone. Today we have named member Jacob Deschenes out of Washington State, and his company is Era Capital Management. Jacob, welcome.
Thanks for having me, Asher. How are you?
Good, thanks. How's the weather out there?
Just started raining. Don't know why.
Well, as you can see, it's bright and sunny over here. Um, so let's get right into it. I usually like to start off looking at the NAAIM Exposure Index. Let me pull that up. Uh, we still have last week's read since this is a special midweek edition of NAAIM Confidential. Last week, NAAIM members were about 89% exposed to equities, down slightly from the week before at 91. Jacob, what's your take on this? What do you see here in the market?
Well, I'm not surprised if people's exposure indicators are saying your trends are pointing north. We did have the Qs have broken out. You see some momentum in emerging markets. So there are places where it seems like the market's breaking out. So I'm not surprised to see members have relatively strong equity exposure right now. But my contrarian brain also then wants me to think maybe the market's running a little rich. So we will see what the future holds.
So, in general, do you see this as a contrarian indicator, coincident indicator, leading?
Well, that can depend. It seems like the markets have pretty tight cyclical patterns right now. And those patterns people are trying to take advantage of. Sometimes, depending on models, there's too much delay in the models, so they might get ahead of their skis. I guess it's really knowing how to ramp up your exposure as things begin to turn and not have it drag you along and buy too far at the top. So, there's a thousand ways of getting exposure to the market. And anyway, it's fascinating to watch what members do, because everybody does things very differently. And of course, sometimes their exposure index is based on just one of their models. So it may just be a sliver of an entire client's portfolio.
All right. Uh, since we don't have this week's yet, but we will by tomorrow. What do you think the outcomes are, and how would you read a tick higher, significantly higher, or significantly lower?
I don't think much has changed in the last week, so I'm going to probably guess it's a very close print.
Taking the contrary view from my suggestions there. Very very good.
Yep.
Okay, well let's get into your management. What is your investment approach? Uh, what is your secret sauce, so to say?
Well, generally speaking, I break up clients' portfolios in three different ways. I only run 7 portfolio models in total, but generally speaking, there's 3 themes that make up those 7. Um, the most basic one that is not active is passive, that I do believe a portion of people's accounts need to stay passive all the time. So there is that component, whether fixed income or equities. Then there is, we'll call it trend-based or momentum-based, where you do trail in and trail out of sectors, hold the exposure that's doing well, and reduce exposure in places that need to be reduced, depending on the cycles, depending on what we're seeing. Not all things go up simultaneously. So there's the trend-based component, like I said. So we have the buy and hold, the trend-based, and then my most unique thing that I offer to clients is the contrarian methodology, which uses individual stocks. And so I'd say in today's world, most advisors seem to use less and less individual stocks as ETFs became more and more popular and easier to use and get any sector, any theme. What else? I mean, there's an ETF to fit any box that you want to fill. So from that standpoint, or what is it that in an article from 2019, I believe, said that like almost over 50% of the market basically was controlled by passive investing. So if people are using the spider and everything else, the S&P 500, the small cap, mid cap, all the different asset classes out there, then that does leave an opportunity for holding individual stocks, because if people are buying or selling those baskets, they're inherently selling the good with the bad, or buying the bad and buying the good. So I think you see more outlier events, and these outlier events happen just purely because if the market goes down, everything goes down regardless of quality, which leads to the opportunity to buy low. And most have a hard time doing that, because when things are scary, you want to run, you want to protect, but in reality, you need to backstop your trend-based systems with something contrarian, because the likelihood that as soon as you sell your indexes, the markets will rally from some kind of stimulus, the Feds, whether fiscal or monetary stimulus. I mean, more things are being, I feel, manipulated. And so therefore you get substantial upside if you can go and buy things when they're low. So,
or just basic mean reversion, right?
yes. And but when I buy a individual stock, I could be holding it for 90 days to 2 years. So I think most mean reversion traders, I guess, would just be looking for a short-term bump, and then they're out.
Okay. Well, there's a lot to unpack there. So that's fantastic. It sounds like you're I don't know, maybe a full stack investment manager, all the way from asset allocation through sector rotation and individual security selection, just covering all the bases, huh?
You have to, and I think it makes it because as much as you can be absolutely unique, and there are some unique strategies that exist out there, you still have to sell to your retail clients some basic key concepts. But they want you there for consistency. So I always tell my clients, look, I'm not trying to hit grand slams. I'm just looking to have this ride as consistent as possible, so that you can feel that there's some form of predictability in your financial world, to the best of our abilities. Now, nothing is guaranteed. Black swan events come and go. Those things are going to be hard to handle. But yeah, I think you need to have all three of those components, like I said, to then do what I refer to as the "what have you done for me lately" component for clients, because they're always going to be benchmarking you or comparing you against something else. It could just be a neighbor at a cocktail party, or it could be some crazy thing on Yahoo Finance.
Jim Cramer, what they heard on CNBC in the morning, right?
Does he still exist?
Yeah.
Yeah.
Cool. So you find with this trend towards passive investing, you think that you see a bigger opportunity to outperform as an active investor. Is that right?
Well, yeah, because then you can take certain sectors will go through good times and bad times, right? We see it all the time. And so you're gonna then be able to take that fine-tooth comb approach. And then, like recently, healthcare stocks were very much out of favor for various reasons. But again, that whole sector was kind of beat up simultaneously. So therefore, therein lies the opportunity. The reason I call my stock portfolio my strategic growth opportunities portfolio for that reason is there will be, no matter what market cycle we're in, something that's out of favor that eventually goes in favor with enough time. But again, if you can get things at the right price, or at a statistical drop, or has it gone down in values in an statistical outlier event that you can then buy at a point that has kind of, we'll call it a hidden floor, right? And that imaginary floor then keeps at least that capital somewhat in a risk profile that you can live within. So yes, there are more and more things where, because most people are indexing, right? Therefore, no matter what, when you index, you usually carry the same systematic risk. You're so diversified that really you just hold the entire risk of the system. And then when you have individual stocks, you can then trickle in, trickle out. You can grow the portfolio holding size, or hold the number of holdings can change. You can get much more granular.
Yeah, I always like to say, with a portfolio of 25 stocks, that's 25 adjustments you can make. But if you're holding, one index and one money market fund, there's kind of only, two you can make. Or
It's more binary. It's on or off.
yeah, exactly. Cool. So you look for bargains. You look for things that are oversold.
And yeah, and I'll also say that I don't necessarily put a lot of fundamental behind it. Now, I do try to avoid, I want to make sure the theme of what the company does is viable, right? So you want to make sure you're not just buying a broken stock, because those can exist, where the reason it's going down is because there is a broken income statement, let's say, that is the reason for it being just decimated. So you got to be careful of those sort of things. So a little bit of quality does matter in your selection process, but you have to, there's just, there's always going to be something that comes your way in any market cycle. Now, that's why I also believe that you should, when you do hold individual stocks, you can really get a lot more beta out of each of your positions. So therefore, you don't have to be 100% invested. When I initially put this portfolio together, my goal was, I'm going to be 100% invested, almost treat this like a mutual fund. There's always got to be something to buy. Don't have cash. Well, I eventually learned that when the markets go up, there's less opportunities to buy things at decent pricing. So inherently, the position sizing shrinks. The number of positions may go from 20 down to 10 or whatever. And then what's nice is, if the market just somehow rolls over on you, guess what? Now you have clean dry powder to go buy the things at prices where everybody else was 100% invested. They already took the hit. And if they're going to switch positions, they're just shifting from, I don't know, mid cap to small cap or something along those lines. It really doesn't provide you additional value doing that, in my opinion. So then again, like I say, when the market goes down, though, then the position sizing grows. The number of positions and opportunities to snag up quality companies is more likely. So, it works. Works very good in tandem with a trend-based system where your core holdings that are ETFs. Sometimes if I'm selling an index fund, I'm also simultaneously buying a stock or two in the other portfolio.
So some self-correcting mechanisms in there to keep everything in balance.
Slightly puts a hedge on the idea that, well, if this is wrong, at least went out and took a stab at this.
And now that interest rates are above neutral, doesn't always hurt to hold cash.
It's beautiful. To be able to earn yield by doing nothing then just adds an enhancement to this strategy that otherwise didn't exist in the last 15 years. So great thing. I hope we never see the ultimate low interest rates that we saw just a few years ago, because that was wrong then. It'll be wrong again. It creates too much speculation. And again, I just hope that doesn't happen. As much as there's people out there just dreaming of interest rate cuts right now, I'm okay with them staying high from the standpoint it keeps speculators at bay.
I agree. I feel like the 2010s were kind of a strange decade in stock picking, and companies that had no business, going up 1,000% were putting up those numbers. And I bet Kathy Woods is hoping for some lower rates, but now my view is things look like they should, given the last 50 or 100 years. So it's back to the good old work of investing.
Well, and you still be surprised how many clients I talk to. I say, so what's your cash position at your bank right now? And they'll name off whatever that they're sitting on in cash. I go, and what yield are you earning on it? And then they go, none, right? I mean, it could be an extreme value, like $100,000 in the bank, just cash, because for whatever reason, that's what they have, with earning zero on it. And so it's real money. And so people haven't caught up yet to the new reality. And anyone who thinks that yields are going to go lower, I just use a simple analogy that says, okay, if everyone is talking about rate cuts, then everyone's standing on the sidelines with their cash, waiting for this supposed cut. So then people would then, once they get the cut, go out and spend something, buy a car, buy a house, buy all the big ticket items that usually they borrow money with to get. It sounds kind of inflationary to me. So
Yeah, I,
simple
I
logic.
always I always think the Fed likes to be begged for them to act. So people are hoping and wishing for rate cuts, but until the economy is really shaky and people start begging them for rate cuts, the Fed's probably happy just to keep things where they are.
Yeah. And I think they're going to just use this language posturing, like dangle the carrot, and just with the idea of hope. I mean, it's if you one thing in this business is you have to learn is do not make an assumption on hope. If you might be waiting a very, very long time, and you may not have enough time to wait before you're just toast.
you know, uh, the language posturing. I had a professor that worked at the Fed. This was like 20 years ago. He even told me they had a name for that. They call it moral suasion.
Interesting.
And
Yeah,
it's
it's a moral dilemma.
explicitly moral dilemma. It's explicitly, he said it's explicitly to try to affect the market and people's expectations.
Yeah,
Um,
without actually making a decision. Absolutely. Yep.
why act
Um,
if you have to? I guess.
it's a strange world. So I don't know. I there's there's just yeah, it's fun to be unique. It's fun to have the unique story. And there's the other thing too is I think there's a thing too, even whether they look closely or not, but having like individual equities sometimes, like, oh, that's cool. I own X, or not X, Twitter X, but just you know the algebraic expression X. But yes, there's some psychology that helps move things along. So, and there's no additional cost to the client too. So the other thing too is you go, well, look, there's no additional expense ratio for holding stock. How neat is that? So anyway,
Absolutely. I always argue that a passive advisor holding ETFs is charging a client double fees.
yeah. Oh, and you'd be surprised how many just buy a basket of ETFs, charge a fee, and then a year or two later, it's still the same basket.
What are the clients paying for?
I don't know, a quarterly
Well,
meeting, maybe.
well, I'm right there with you. I love individual stocks, and I have a client who um, uh, he came to me because his previous advisor just sold half of his individual stocks, bought some ETFs, and it bugged him. He came to me and he just called me up every couple weeks, talk about the latest thing I bought for him. Just loves the idea of owning a company and voting the shares and thinking of, thinking about that connection rather than it's just a financial account for them.
Yeah, because then it becomes pretty vanilla with just some of the indexing. And again, what's the value the advisor giving towards the client with just that passive portfolio? And this is also what I tell people too. I go, okay, fine. You don't want to hire an advisor. That's perfectly fine. I completely get it. Here's the thing though. If you build your portfolio, set it up, forget it, never touch it. Because what usually will happen, it's hailing outside now, so there you go. Usually what happens is that inexpensive portfolio that the client put together, they will wake up one day, read some bad news on the market, and then turn around and go, I need, the fear sets in. I need to do something. I got to get rid of this nasty feeling that I'm feeling. And then they sell. But then the next question is, when do you get back in? And then that self-directed account then becomes the most expensive account that you could think of. So yes, you didn't have an advisory fee, but it comes in other forms.
I think Warren Buffett said this is a game of who's got the best stomach, not who's got the best brain, or something like that. He's probably said it a lot more eloquently than that, but absolutely. So, what do you? What's your outlook for the future? Do you think we have a recession coming? Do you think it doesn't matter as long as you can pick individual stocks?
Well, that's it. Yeah, I would say it doesn't technically matter, but things I'm watching are, I think you have to remember back when interest rates were low, how many people borrowed money that had no reason to be borrowing money. There is a big chunk of the demographic of this country that is silently suffering from higher interest rates, whether it's the low interest HELOC they took out, that's the big one. The second mortgages that people are paying that have variable rates, those are hitting people hard. And the other thing too is watching this, or finish the thought on debt. There's just a lot of debt. I think a lot of people overextending themselves. So we're going to really have is kind of a barbelled approach or a barbell type function going on in the economy, where you got those that have lots of cash, lots of assets, are doing just fine, that have almost no debt, and they're living life perfectly. And then there is a huge chunk of people that are living with a ton of debt, trying to get by because this inflation is just absolutely painful. And they can't work enough hours to fix it. So there's just so many things I think that are going to be headwinds. Now, I never say that alone is going to be what causes a recession, but it definitely is something where if you're watching your neighbors and the decisions they're making, be mindful. And if you run a business and if you know who your customers are, and you might need to understand that they might be strapped for cash as time goes on, as things have gotten as expensive as they have gotten. So yeah, it is unfortunate. And then the other thing is AI. There's a lot of people excited for AI. I'm personally the one that's not. I think we're going to remove more humanity from humanity already, that's already been sucked out from social media influencing and things of that nature, right? People just using most of their life is being spent on a screen. And you have to understand that in the world of business, you have creative destruction. That creative destruction is that companies are always looking for ways to remove their employee count. It never goes away. So you just have to understand that is a thing. So if this AI becomes really powerful, yes, there's a lot of middle income, middle wage positions that probably will get hurt. And we need to understand that that's a reality. Now, Investors may find this absolutely wonderful, but there is a drawback to it. And I don't know. It's just, again, you just have to be mindful of its existence and plan accordingly to make sure that you as an individual are, I guess, unreplaceable.
Yeah, absolutely. I just read a quote from a writer who writes a lot about how AI is replacing writing, and he doesn't like it because, again, it sucks the humanity out of it. He just said today on LinkedIn, said writing is hard because thinking is hard. So,
Which makes it worth reading then too.
yeah, exactly. So if you have an original thought, yeah, the AI can write it out, but if you are having the AI do your thinking, then it's kind of worthless content that it's
Mm-hmm. Yep. And and now how are we going to know what's real and what's not? That's
making.
going to be
Yeah.
another thing too. So you better off just maybe ripping the TV off the wall, getting rid of it. And honestly, on our end, my wife said, I want the TV gone. And that was back in January. And we still have not got a TV in the living room. Yes, it is hard, but you'll go to bed earlier. and 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 guess what? People say, well, what do you do? I go, I do stuff. I actually do things. And that's the point is really is and I think you actually will be happier because in essence most of the content on the internet is not really worth consuming and it will probably only get worse.
I always say they stopped making good movies like 10 years ago, at least.
Right. Because there all CGI'd and
Yeah, they're all the same thing.
I'm always disappointed when I see a movie that's just an overblown CGI mess. And
It's a cartoon.
yeah, I'm because real cinema, there's some real clever techniques that special effects artists had to do. And if you're paying attention, you'd be like, whoa, how'd they pull that off? So
Cool. Well, let's close with a quote. What is a good investing quote?
well, I was kind of leaning on that AI thing. So if people are just listening, they want to read two authors that kind of more or less formed the mindset of how I kind of came to how I do what I do for my clients. Nassim Nicholas Taleb, by far, Anti-Fragile, Black Swan, gotta read that stuff. And one of his quotes, is all technology really is about maximizing free options. So again, understand that technology is replacing something, right? People are looking for that efficiency, and we need to know that, yeah, there is going to be maybe a dark side to this with enough time. And well, more or less is people need to be spending more face time with each other and for that happiness to come for that happiness to be had. So, and then I would say also behavioral economics stuff is fantastic. So read the book Predictably Irrational. That one, just very simple read, but it makes you go, oh, okay. It's so not every decision is ever built on what is it? All available information, right? People are tricked, manipulated, coerced, used, things are not people are not rational. And so you need to understand that. And markets are the same way. Just because people are buying and selling a stock and it's moving higher doesn't mean it's rational, right? So know how to take advantage of irrational moments in time because there are opportunities that lie within that. So yeah, I'll leave it at that, I guess.
Cool. Let's dive in a little bit. You said Nassim Taleb says all technology is based on maximizing free options. Is that
Really is about, yeah.
like a free option? When I was on a trading desk, we'd always say that like, oh, this client's asking for a free option. We can't give that to them. Is that what you mean? Or
Well, meaning that people are just looking to utilize the tech, I think. I mean, without reading the context of it, that the technology in essence kind of is a free ride. Like what it provides to you is almost free, right? As far as the utility of it. So, um, and there, of course, people leverage tech to then save somewhere else. Um, and um, yeah, if that's kind of how I interpret it anyway. But I see where you're going, and then you're talking about actual options. And so that maybe that's the context.
well, it was a free option. It was like if a client took too long and the market moved while they were deciding whether to buy or sell, we say we're giving them a free option. You can't do that, but
Oh, I see. Yeah, yeah.
yeah, I think I see what you mean. But so like if you have a machine that makes a product, it just makes that product at a fraction what the labor would cost to make it by hand. Um, it's like minimizing that cost, making it practically free.
Yeah. So in essence, I mean, other than the small input cost, right? Yeah. I mean, if you just see how anything's manufactured to this day, that's the speaking of inflation, I've also thought that the reason why we're having inflation now is because a certain degree of how we're able to manufacture goods and services now has reached all the easy fruit has been picked, because a lot of inflation has been avoided because of efficiencies. And then, but now most of the stuff that we buy is very automated in its production. So now the question is, where's the easy fruit to squeeze out that efficiency? If the humans have been kicked out and now it's machines doing it, what's next? How does it get any easier? So yeah, those are just whether that is true. It makes sense in my brain, and that's, I guess, all I can do with it.
Yes. So we're seeing inflation now because we're growing our consumption at the same rate, but we've kind of capped out on productivity gains to offset the costs.
Correct. Correct. So I think a lot of prices being passed through have been, or prices have not been passed through in the past because they've just found a way to bring a machine in to do the work instead of humans. So therefore they just assumed the savings through labor, right? Through not having to pay labor. So
Gotcha. Wow. Well, hopefully we can find a solution, or get back to good old handmade, high quality goods.
well, and yeah, I think people will begin to appreciate and pay for that stuff more and more with time too. Again, because it's a human element.
Absolutely. Well, great. Well, thanks for joining. Thanks for joining me today on the NAAIM Confidential. Jacob, where can we find more about you?
You can go to my website, eracapitalmanagement.com, and my email and everything else is there. I don't do the socials, so you just have to find me the old-fashioned way.
The old-fashioned way, with a website and email.
Yeah, you can pick up the telephone too. I don't mind that.
Fantastic. Great. Well, Jacob, thanks again. Have a good holiday weekend.
You too.